Hello, ladies and gentlemen. I welcome you back to our lecture where we are continuing from where we left. In the previous videos, we looked at the cost of capital, starting with the cost of equity and then cost of debt, including the cost of preference shares. We also did cover the valuation aspects related to each cost of capital in terms of the values, the market values of the respective finance uh, for these capitals. Okay, for example, when we looked at the cost of equity, we also looked at how to value equity in market value terms. Okay, so we were looking at both the cost of the capital as well as its market value. For example, in terms of equity, we looked at the cost of capital, that was KE, and we also looked at the market value of equity, that is MVE or simply VE. Okay, and then when we looked at debt, okay, at debt, of course, there were various forms of debt where we looked at KD, irredeemable, okay, and we also calculated the market value of debt. All right, so there was KD redeemable and also KD convertible, as well as KD bank loan. Then for preference shares, we calculated the KP as well as the market value of the preference shares. We did this, and we also concluded by calculating the WACC. That's what we did. However, in this particular video, we are now going a step further into the optimal capital structure. The optimal capital structure. This part is building on our week 5. Remember the week 5 task where we touched on capital structure part 1, where we looked only at the role played by fixed costs in the capital or in the profitability rather of an enterprise, where we looked at two gearing measures, that is financial gearing as well as operational gearing. Okay, both were telling us something about the fixed payments or fixed costs a business can face. For example, when we looked at financial gearing, okay, when we looked at financial gearing, we discovered that financial gearing, which was debt, that is financial gearing, was equal to debt over equity. Okay, and sometimes it was seen as FG was also seen as debt over equity plus debt. Okay, we looked at these issues, all right, but we discussed something about the role of debt, where we said that debt has got some fixed elements in it because it calls upon an entity to bear fixed interest payments, which would actually be a burden on the firm's profitability. All right. Then we also looked at operational gearing. Okay, operational gearing, and we said that operational gearing, or G, was equal to contribution over PBIT. And we discovered that those companies which are heavily geared, okay, which are heavily geared, tend to have some drastic um, changes whenever on their profit, the ultimate profitability. All right, so the higher this ratio, um, the the less profitability an enterprise could be. All right, please just refer to that video where we covered these issues. All right, so that was a week 5 video. Now we want to touch on what determines the amount of debt or the amount of equity. Let us just say the ratio of debt and equity. What determines that? All right, especially, so we are now focused on in more detail on the financial gearing. What determines this ratio in a particular firm? All right, so we are guided by various theories. However, what is essential to note at the moment is that you still remember that when we calculated, for example, our KE using the dividend valuation model, okay, when we calculated KE, let me try, please allow me to erase some of these things. All right. I hope my pen is not going to misbehave. All right. If you still remember, when we calculated KE using the DVM, we said that KE is equal to D over PO. All right. And we said that in this case, the market value would be market value, that is PO, market value of a share, PO, is equal to D over KE. In this case, the trick is that the KE should be as low as possible for the market value to be high. For example, let us take two scenarios. Let us consider a scenario where KE is equal to 10% and where KE is equal to 20%. Okay? Now, and let us say the dividend that has been paid on a constant basis has been $2. So D has been $2. All right. So if KE is 10%, then PO is equal to $2 over 0.1. And this gives, let me look for my calculator. So this gives a PO of $20. However, if KE is 20%, then PO is equal to $2 over 0.2, which means 2 over 0.2, that's only $10. So you can see that the higher the discount rate, the lower the market value. So we want to build on this assumption or on this reality in this current lecture. So when we did calculate the WACC as our discount rate, we are also going to base our views on the reality that the lower the WACC, the higher the market value. Okay, because remember we said that the WACC of a firm, is its average, that's the average of all its capitals. And we identified that a firm could have several forms of capital. For example, it could be financed by equity, it could be financed by debt, and several types of debt. That is, it could be financed by irredeemable debt and redeemable debt, as well as bank loans and also preference shares. Okay, so by the end of the day, we then need to weight up all those capitals and come up with an average. Now, the essence is the higher the WACC, the higher the WACC, the lower the market value of the firm. Okay? Now, what are we saying? We are simply saying the market value of the firm is equal to the future cash flows. The future cash flows obtained from this firm's operations, all discounted by the WACC. So this is actually, we are simply developing from this association. Okay, the market value of the firm, that is PO, is equal to the dividend divided by the cost of equity. But in this case now, when we are looking at the WACC, we have considered the equity, the debt, everything, and obtain the average cost of capital. So the future cash flows from a firm is its dividends. Okay, in the eyes of an investor, the future cash flows are those dividends that are going to be earned from their investment in a particular firm. So the dividend is actually the future cash flow stream. So when we discount that dividend by the WACC, we get what is called the market value of the firm. Okay, and we did calculate, or we did show you how to calculate the WACC in the previous video. Please replay that video. All right, so you can also see in this computation which we use that the higher, the lower the WACC, or the lower the discount rate, the higher the market value. In this case, when the discount rate was 10% and the dividend was $2 in perpetuity, or just $2 constantly, then we ended up having $20 in terms of the market value of the share. And when the cost of equity was 20%, then the market value of the share was shrinked to $10. So the higher the discount rate, the lower the market value. So firms strive by all means to make sure that their WACC is minimized, to make sure that the WACC percentage or the WACC rate is lower, because the lower the WACC, the higher the market value. Okay, now there are theories which explain why it is so within companies. Okay, there are certain theories which actually assist in explaining why the relationship between debt and equity has an impact. Because you remember very well that debt has got its own obligations, as we have seen in our introductory part, where we said that when a firm becomes heavily geared, then it has got a lot of interest obligations which are fixed, which it needs to settle. That on its own impacts on its profitability. All right. So the more the firm gets geared or levered or has its debt increasing, then we are having a situation where its profitability starts to be variable. There will be a lot of volatility in its returns. There will be a lot of volatility in its profitability, which means that shareholders, by the end of the day, would require a higher return. They would expect more in terms of their returns. All right. So the cost of equity in the end will rise. So the capital structure of the company, all right, which is the mixture of equity and debt. All right, the capital structure has a bearing on the work itself. All right. So we need now to look at the theories which have to give us the answer as to what should actually happen. All right, in order for the wealth of shareholders to be increased. All right. So when we are looking at the capital structure now, we will be looking at what motivates managers to have a certain level of gearing. Why should companies maintain a 50% debt and 50% equity ratio, or should they have more debt than equity, or should they have more equity than debt? This is the purpose of this video. Okay, there is this interesting question. Is it possible to increase shareholder wealth by changing the capital structure? We already know that there are certain companies who are, which are all equity financed, which means they don't have debt at all, while others could have low levels of equity and higher levels of debt. Why is it so? That's the question. Hence the question, is it possible to increase shareholder wealth by changing the capital structure? Shall we decide to just be 90% levered or geared, that is to have debt that is 90% of the total capital of the firm, or shall we have the opposite? All right. So in short, what can what seems to be obvious is that the higher the gearing, the more riskier the investment would be, or the more volatile the returns from the firm's investments would be. This is because of the higher levels of interest obligations which the firm has to bear. That is actually the most instinctive response we might give. However, there are theories which argue that sometimes gearing, sometimes to be heavily geared is the best way to go. All right. So we are going to start to look at, at the traditional view. All right, because there are various theories, and for this paper, we are only required to know about 3 of them. Okay, and we are going to start with what is called the traditional view. All right, so let us look at that one. Okay, now the traditional view to capital structure is as follows. Number 1, as the level of gearing increases. The cost of debt remains unchanged. Up to a certain level of gearing. So the belief of the traditionalists is that not all gearing is going to raise the cost of debt. Okay? So which means firms can actually increase debt finance. Okay? They could increase their gearing levels, but up to a certain level of gearing. Okay, which means beyond this level, the cost of debt will start to increase. So beyond a certain level, the cost of debt will start to increase. Now, number two, what could be the impact of this arrangement? Okay, what could be the impact if we increase debt and debt and debt? Does that have an impact on equity, on the cost of equity? The answer is yes, as gearing increases. The cost of equity will rise. So the cost of equity will also rise as the gearing. Remember, we said gearing is not always going to rise because we are increasing debt. But there is a certain point when we reach that one, or when we go beyond that point, then the cost of debt starts to rise. Now, as we continue getting geared or increasing the gearing, this will also impact on the cost of equity. Why is it so? This is because of the assumed interest obligations which would increase financial risk. Financial risk is the risk that we will fail to honor our financial obligation. We will fail to honor our financial obligations. All right? Because as the debt continues to mount, it means there will be more lenders who would want their interest, including the principal amount, to be repaid. And we will discover that we will be failing to meet those obligations. All right. Then, number three, the work does not remain constant, but rather falls initially. Okay? As the proportion of debt capital increases. But then, I mean, but then starts to rise as debt begins to rise significantly. So that is beyond that point when the KD would also start to rise. Okay, so what then is the optimal level of gearing? The optimal level of gearing, okay, number 4, the optimal level of gearing is that point where the work is at its lowest. Remember, we say that initially the work falls as we continue getting geared. Okay, so initially as we increase our gearing, the work falls. All right, up to a certain point when our gearing becomes so significant that the work starts to rise. All right, so let us show this graphically. Okay, what we are saying, ladies and gentlemen, is this one. This is our graph. Okay, I'm not a good artist, so please bear with me. I'm not a good artist. Okay, so this is the cost of our capital. Cost of capital. All right. Now, when we are saying cost of capital, ladies and gentlemen, whatever element of capital is actually being considered here. All right. Whatever element of capital is being considered, the cost of debt, the cost of equity, in total. Okay, that's the cost of capital. All right, so we are saying this is our work. This is our work. Okay, so initially it continues to fall up to a certain point and then it begins to rise. So this is our work, the weighted average cost of capital, and this is the level of gearing. Okay, so initially in the first phase, okay, this is the first phase. All right, the work falls up to a certain point, okay, like this point. This is the point, okay, which we are saying this is the optimal point. Okay, so at this level of gearing, at this point, the work is at its lowest, and the firm should actually stay there. Okay, because that's the point the work is at its lowest. Okay, after this point, this is the danger zone. Okay, this is the level 2. Okay, at that point the work will start to rise, and remember I said in the initial part that the higher the discount rate, the lower the market value of the firm. Okay, the higher the work, the lower the market value. So we don't want this point. Okay, we don't want this point, is not allowed because the work is beginning to rise. So we don't want that point, because the higher the work, the lower the market value. So we don't want this point. Do not allow firms to go beyond point P. Beyond P. Don't go beyond point P. This one is not allowed, but this one is fine. Okay, that is it. So basically, what is happening is that let me just draw this graph again so that I show the changes in the cost of capital. All right. That is, remember I said the cost of capital includes the cost of debt, cost of equity, and whatever other capital there be. All right. So we are saying, remember, usually the highest, the riskiest form of capital is equity. Okay. The cost of capital and the level of gearing. Okay, so we are saying equity is actually the form of capital that is more expensive. All right. So what happens is as we get geared, right? As we get geared, the cost of equity does not necessarily rise. It rises gradually, but then starts to rise exponentially as we get more geared. Okay, so this is the cost of equity for a geared for an ungeared firm. All right, cost of equity for an ungeared firm. All right, but then this cost of equity initially was low because the firm was not geared. However, as the firm gets geared, you see that KEU starts to rise. Okay, initially here it was ungeared. Okay, but as the firm starts to be geared, you can see that KEU starts to rise. Okay. Then we have KD. Our KD is low. Okay, the cost of debt is usually low. Okay, so initially the cost of debt was actually low. However, it then starts to rise because of the firm becoming heavily geared. Then we have got, remember, what happens is the cost of equity is equal to work when the firm is ungeared. So initially here at the initial phase at point 0, or when the gearing is 0, this is when gearing is 0. Okay, KE is equal to work when gearing is 0. So the graph of work, the work graph, also starts at the same point. This is the work, because initially it will fall, but it will also rise as gearing increases. But at this point, when gearing is 0, then KEU, the cost of equity ungeared, is equal to work. At that point, because we had no financial risk, we were not geared, so our work was equal to the cost of equity. Please get these theories right because they are always going to be resident in your exam. Okay, now let's look at the drawbacks of the traditional view. Okay, the drawbacks of the traditional view. All right, we can also appreciate that at this level, using this graph, you can see that the optimal level of gearing is at that point when the work is lowest. So as before, this is the point where we need to allow our managers to have their gearing at. That's the level we want them to be geared. Okay. However, this theory, the traditional view, has a shortcoming that it doesn't tell us, it does not identify the the optimal level of gearing. What it tells us that at this particular level, that's when you guys should not exceed. But what is that level actually? We are not told. Okay, so it is just an issue of assumptions. It is an issue of assumptions. What is P? We don't know. Okay. The other shortfall is that this view does not take into consideration the impact of tax. It neglects tax. It doesn't put taxation into consideration. So that's one of the pitfalls of the traditional view. All right, now let us look at the Modiglian and Miller snow tax model. All right, Modiglian and Miller snow tax model. It is sometimes called the operating income view. Okay, one thing I want to mention, some people might be worried and say, if there is no tax in this assumption in the traditional view, then how come debt is cheaper or is considered to be cheaper? Now, the assumption here is that debt finance is generally considered cheaper because in the hierarchy of creditors, debt holders are given priority, okay, in terms of restitution, okay, in terms of the liquidation process, okay, they are given priority before the shareholders of the firm. All right, so this is why their expected returns are lower than those of equity holders. All right, so here do not make a mistake of assuming that the debt is lower because of taxation, because this theory does not talk of tax. It has no tax implications in it. That's the theory. Okay, so don't be confused and end up talking of taxation impact when we are discussing the traditional view. There is no tax. All right, I'm sure that point has been driven home. Okay, now let's move on to Modiglian and Miller's no-tax model, that is the 1958 model. Now, in 1958, Modiglian and Miller stated that assuming a perfect market, okay, and when you're talking of market, we are referring to capital markets. Okay. Assuming a perfect market, all right, and ignoring taxation, the work of a firm remains constant at all levels of gearing. So which means as the company gears up, the decrease in the work, okay, as the company gears up, the decrease in the work is offset by the increase, okay, in the work. The decrease in the work due to cheaper debt, remember, okay? The decrease in the work due to cheaper debt is offset by the increase in the work due to the increase in KE, the cost of equity, owing to increased financial risk. And when we are talking of this financial risk, ladies and gentlemen, we are referring to the interest obligations. Okay, interest payments, those obligations, they are the financial risk we are talking about. The repayment of the debt, interest. Okay, and it includes the repayment of the debt interest as well as the principal. All right, the more we get heavily geared, there are a lot of interest obligations we need to commit ourselves on or to, and then the repayment of the principal. So this is what happens now according to the Modiglian and Miller no-tax model. The cheaper debt will cause the work to fall, but at the same time, because we are continuing to get geared, then the financial risk is going to trigger a rise in KE, that is the cost of equity. And remember, when the cost of equity increases, obviously the work is going to be affected. Eventually the work is going to rise. Okay, so this is actually what happens. But they are saying in this theory, this means the work is going to remain constant, because we are simply saying increase in KE is being offset by a decrease in KD. By the end of the day, the impact is zero. Okay, by the end of the day, the impact on the work is zero. So which means our work is going to be unchanged. So let us depict this information graphically. Let us depict this information graphically. So you can see that this is our graph, ladies and gentlemen, where we are having our cost of equity, the cost of capital here, all right? And this is the point where we were ungeared. Cost of equity ungeared at point 0. This is the 0, signaling that that's the point when we did not have debt at all. All right? When we did not have debt at all, KEU was equal to work. So you can see that at this point, KEU is equal to work, because this is our work. Remember, this is our work, the graph work, and this was our KEU graph. However, it now becomes KE geared because we were now geared, and you can see that the graph of the cost of equity had risen. Okay, it had risen because of the gearing. Okay, because of the gearing. All right, and KD, of course, remained as it is. The KD doesn't change because KD is considered to be cheaper. All right, KD is considered to be cheaper. The cost of debt is considered to be cheaper. Why? In what sense? Not in the sense of the tax deductibility of debt. No, not at this point. Not at this point. Don't worry. But because the assumption is on the creditor hierarchy, where we are saying that these guys are going to have their money back when things get sour, when the company fails. Everything that the company owns would be sold so that the creditors get their money back. So their risk is minimal. But these guys, the shareholders, you can see that as gearing increases, the cost of equity was increasing. However, this increase is offset by the cheapness of debt. All right, is offset by the, because debt is always going to be cheaper. All right, so the increase is offset. This is why you are seeing that there is no impact on the WACC. The WACC is just a constant line. So this means that the market value as well is going to be just the same whether the firm is ungeared and or is geared. The market value is just the same despite the level of gearing. The value of the company is just the same. Are we together, ladies and gentlemen? So according to this M&M no tax, value of the firm ungeared is equal to the value of the firm which is geared. Okay, I think we need to look at a more convincing example in figures. All right, let us look at this problem in figures and see if we can make sense out of this presentation. Okay, a company has $5,000 of debt at 10% interest. Okay, and earns $5,000 a year before interest is paid. There are 2,250 issued shares, and the weighted average cost of capital of the company is 20%. The market value of the company should be as follows. We are having earnings of 5,000 as you can see, and the WACC is that one, and we know that the market value of the firm is equal to its earnings, the earnings over WACC, over the WACC. So in this case, the market value would be $5,000 divided by 0.2, which was the WACC. Remember, the WACC is 20%. All right. So in this case, the market value is $25,000. All right. Then let's the market value of debt. Less market value of debt. Okay, the market value of debt is how much? According to the question, the market value of debt is $5,000. So if we deduct 5,000, this debt, we are left with the market value of equity. Okay, market value of equity. That's $20,000. Okay, remember the market value of the firm includes both the market value of equity and the market value of debt. All right, so here we have actually dissected this point. Now, what is the cost of equity? Okay, the cost of equity, let me use another pen. In this case, the cost of equity would be the cost of equity would be all right, our earnings are 5,000. Okay, the earnings are 5,000, but remember we need to adjust these earnings. Okay, we need to remove the interest component. So that's 5,000 minus the 500. Remember, the debt is 500, as you can see here, and it pays interest of 10%. So the interest in this debt is equal to 10% multiplied by $5,000 worth of debt. So that's 500. So this is the 500 we are deducting from our earnings. Okay, all divided by the market value of equity, which we determined to be 20,000. Okay, so this means 4,500 over 20,000, and the the cost of equity in this case is 22.5%. Okay, now what about the market value of the share? The market value per share. Market value per share. This one is given by 4,500, okay, over the number of shares issued, 2,250, okay, $4,500 over 2,550. All right, and remember this. Remember our PO. Remember the formula for our PO. We said PO is equal to D over KE. Okay, and remember this is our KE. The 22.5% is our KE. All right, and in this case, the 4,500 is our earnings. Okay, that's the earnings. The company has made those earnings. All right, and you can assume that they are our D. All right, so we want the dividend per share. All right, some form of dividend per share. Remember, at this level, you need to think critically. You need to have some art in the way you are answering the questions. Okay, if you are just adamant and static, okay, without being dynamic, then by the end of the day, you will be tossed left, right, and center with these questions. So you need to be dynamic, okay, have to exercise some dexterity in your answering. So that's 4,500, okay, divided by KE. All right, divided by KE, and our KE is 22.5, that is 0.225, 22.5%. Okay, and what do we get? So that's 4,500 divided by the number of shares, 2,250. You get $2 over 0.225. You get $8.89. Okay, this is our PO. Okay, that's the PO, the market value per share. Now, let's move on a step further. Suppose there are changes now, because remember we want to prove that even if whatever change occurs on the debt, on the cost of debt, and the cost of equity, the market value is not going to change. So we expect this market value of a share not to change. The market value is not going to change. That's the point of contention. Now, let us say the level of gearing has been increased. Okay, we issued more debt. We issued more debt. Okay, that is a further 5,000 debt has been issued at the same interest rate of 10%. So we issued a further 10%. I mean, we issued 5,000 more debt at 10% coupon rate. Okay, that's what we did. All right. And now we then repurchased about 562 shares. Okay, we repurchased our shares at that market value of $8.89, which means we left about how much? 562 from our shares 2,250. That is, we are left with 1,688. Okay, shares in issue. Okay, so this transaction is not going, this reduction in shares and increase in debt is not going to change our work. Okay, this means this means the work is going to remain at 20% as usual, and market value of the firm is going to be 25,000 as usual. This includes market value of equity, which was 20,000, remember, and then market value of debt, all right, which was 5,000. However, this is no longer the case in terms of the composition of market value of debt and equity. The figures have changed, but the total is going to be the same. Okay, remember, because we have issued further debt of 5,000, all right, so in that basis there is going to be a change. Okay, the market value has moved now. The market value has moved, so you must expect a change. Okay, the market value of debt is now 10,000. Remember that. Sorry, oh man, I ended up deleting everything. Okay, this means the work is going to remain, that's going here, to remain at 20%, and market value of debt, remember, is now 10,000. So which means here we expect to be 15,000. But what it means is, by the end of the day, the total should just remain 25,000 if the theory is to be true, if the theory is to be true. So let us see what we need to do. Okay, now remember that our earnings have not changed. Our earnings are still 5,000, remember? And we say that work is not changing, is still 0.2. Therefore, our market value is equal to 5,000 over 0.2, which means it is to 25,000. Okay, it is to 25,000. Okay, and I say that this 25,000 is made up of the debt, market value of debt, which is now 5,000 plus the new 5,000, and it is now 10,000. So obviously the market value of equity is 15,000. Okay, now what about the annual dividends? Annual dividends. Initially, the dividends were 4,500. Okay, initially the dividends were 4,500 before the interest. I mean, they were 5,000. Okay, they were 5,000 before the interest, but now we put interest, and the interest was 500, so they were reduced to 4,500. But in this case now, the dividends are going to be reduced from 5,000 to 4,000 because the interest has increased. Our interest, the new interest now, please take note. New interest is equal to 10,000 because the debt is now 10,000. 10,000 multiplied by, sorry, h. It's now an issue of inertia now. Multiply by 10% because the coupon rate is to 10%. Okay, the coupon rate is to 10%. So this means we are now paying interest of $1,000. So we come here and say annual dividends are now the profits, the earnings of 5,000 less 1,000, and we are now left with 4,000 as dividends. Okay, now what is the cost of equity? Cost of equity, KE, is equal to our dividends, 4,000, okay, less market value of equity. The market value of equity now is now 15,000. It is no longer 20,000 as in the initial arrangement. It's now 15,000. Okay, and this means the cost of equity is now 26.66, okay, 0.667%. All right. So what about the market value? The market value per share. Market value per share. Market value per share, we are saying our earnings are now 4,000. Okay, but our shares are now 1,688. Remember from the changes, we said that we had to buy back other shares using the debt which we borrowed. Okay, and we bought back our shares to leave them at 1,688. So you need to follow the scenario in the exam. Otherwise, if you do not pay attention, you are going to be thrown overboard. All right, so this is our D. And what is our KE? Our KE is this figure. So divided by KE, the KE is 0.26667, excuse me. And you must get your $8.89. This is your PO, market value per share. And you can see that this is the same market value per share, which means the changes in the cost of equity is not going to have any impact. Okay, is that clear, ladies and gentlemen? All right, now let's look at Modiglan and Miller's approach with text model. Now, in 1963, Modiglan and Miller revisited their theory. They discovered that businesses, the assumption that there is a perfect market is too simplistic and not real. They discovered that it wasn't a real assumption. Taxation was determined to be very, very real. Okay, so they had to incorporate taxation in their model. But this led to drastic changes and conclusions. Okay. So this led to drastic changes and alterations to their former conclusions. So there was some alterations to their initial conclusions. All right. So in this model, as debt became even cheaper due to tax relief on interest payments. The cost of debt, KD, falls significantly. From KD to KD multiplied by 1 minus T. Remember the tax adjustment? Okay. Thus, this is now the drastic conclusion. the drastic change. Thus, the decrease in the work due to even cheaper date is now greater than the increase in financial risk. The cost of equity geared. So you can see that in this particular theory now, Motiglan and Miller were now appreciating that tax was real and we are not living in a perfect market where there's no taxation. But there are some benefits associated with this taxation because interest payments are tax deductible. Therefore, firms are even going to enjoy more on debt finance apart from debt holders being given priority on the creditors hierarchy. There is also the tax deductibility of debt. On top of that advantage, there's also a tax deductibility of debt, which makes debt even cheaper. You know, the term even simply means that prior there was a certain advantage. Okay, so prior debt was just cheaper. Okay, but now with the introduction of taxation, debt was made even cheaper. Okay, so please, this is the theory that talks of tax deductibility of debt. All right, so the work falls. This simply means that as we engage in more borrowing, we are simply decreasing the work. Okay, so work falls as gearing increases. Therefore, if a company wishes to reduce its work, it should borrow as much as possible. Okay, so basically, the theory advocates for more borrowing, even up to 99.9999% gearing. So you can borrow as much as possible. Okay, that's this theory actually identifies an optimal capital structure. Okay, the companies can borrow as much as they can, although we are going to discuss why companies are not going to borrow as much as they can. Okay, we are going to discuss about that. Why? Because we can see from this assumption that Motiglan and Miller still had the idea of a perfect market in their brains. They still believe that markets, capital markets, were just perfect. So they only singled out that taxation was there, but hey, there's still some perfect operations, some perfect market conditions. They still do exist. But you discover, as you discuss further, that there is no such a thing. Okay, let us draw the graph of this model. Okay, the M&M with tax. Okay, this is the graph, ladies and gentlemen. As you can see, as usual, when we are zero geared, when there is no gearing, okay, when there is no gearing, it simply means we are 100% financed by equity. So at this level, our work is equal to this, the point of KEU. Okay, so you can see that the work is equal to KEU. All right. But as we increase our gearing, as you can see, this is the level of gearing. This is our gearing. Okay, we can gear up to 100%. All right, and as we continue to get geared, as we continue with the gearing, you can see that the our KD is just constant. Okay, the KD is just a straight line, it's constant, but you can as well see that the work is falling. This is the work. The work continues to fall. All right. Don't know what's happening with my power. Since my power has got a problem, the power connection. Okay, so the work is continuing to fall, as you can see here. This is the work. It is falling and it is continuing to fall. So this means that a company can get geared up to 100% level, and if not only for legal reasons, companies could be 100% geared. However, you will discover that in most jurisdictions, the Companies Act would forbid for a company to be run without shareholders. All right, but in essence, companies can be allowed. I mean, it is actually, according to this theory, it is more profitable to get your finance in the form of debt other than in terms of equity. All right, so as you can see here, while this KE, cost of equity geared, continues to rise, the ultimate work continues to fall. All right, which means the taxation effect and as well as the already the original cheap value of debt have got a more bearing on the work than just the impact of the financial risk which is associated with the cost of equity geared. So ultimately we can say it is much safer to finance your company with debt. However, because this assumption or this theory was based on the view that we are operating in a perfect market, you could see that it actually tells the half truth, or it simply tells not the full truth, because on the ground there are a lot of market imperfections that exist. All right, here we simply see that this theory is telling us that the more we are geared, the higher the market value of the firm. So the value of the firm geared is actually more or much higher than the value of the firm ungeared. Okay, so the theory actually advocates that we need to get more geared as we can. That's the idea. Okay, however, as I have already indicated, there are a lot of market imperfections which might render the assumption void. Okay, for example, the truth is that when M&M were proposing this theory, okay, they were anticipating a perfect market, which says that whenever managers or finance managers want to fund their investments, the capital was readily available and at low cost, and information asymmetry was at minimum. Okay, but in reality, it does not work like that. If companies continue to get geared, there is a risk of them failing to repay their debt, or ultimately failing to be in business at all. Okay, so there are some bankrupt costs. Okay, because as these companies fail to repay the lenders their money, they will actually be put on liquidation. Okay, they will close shop and that cost would have some unwanted consequences. Okay, so the more we engage in debt finance, the higher the risk we are going to take in terms of financial risk, where we end up failing to pay our debt. Okay, and this will mean that the required return by shareholders is going to be too much high for the company to be competitive. All right, now there is also an issue of agent costs. All right, so at the higher levels of gearing, there are also agent costs as a result of action taken by concerned debt holders. Providers of debt finance are likely to impose restrictive covenants such as restriction of future dividends or the imposition of minimum levels of liquidity in order to protect their investment. They may also increase their level of monitoring and require more financial information. So this simply means that in as much as debt might look attractive, it comes with certain costs, which among other things involve the imposition of restrictive covenants, all right, which means that there could be some impact in terms of the level of dividend which we will be able to pay our shareholders, and that might end up having the negative clientele effect, okay, where when our shareholders are annoyed, they might end up disposing of the shares en masse, and that would crumble the share price of the firm and also our goodwill to potential investors, which might also impact on our ability to raise equity finance. So we must be very, very precautious. Okay, we must be very precautious when it comes to increasing debt. There's also an aspect of tax exhaustion. Okay, as companies increase their gearing, they may reach a point where there are not enough profits from which to obtain all available tax benefits. They will still be subject to increased bankruptcy and agent costs, but will not be able to benefit from the increased tax shield. So this is another point we need to consider. Okay, lastly, let's talk of the pecking order theory. All right, this theory simply tells us what is obtaining on the ground. Okay, so it tells us what companies are doing and not what they should be doing. So the pecking order theory is in sharp contrast with the theories that attempt to find an optimal capital structure by studying the trade-off between the advantages and disadvantages of debt finance. In this approach, there is no search for an optimal capital structure. Companies simply follow an established pecking order, which enables them to raise finance in the simplest and most efficient manner. The order is usually as follows. Okay, as we discussed in one of the videos previously, we said that it is most encouraged, or it is most safe to fund whatever project with our own internally manufactured funds, the retained earnings. Okay, then we have to engage into debt finance, but by starting with a bank loan or loan notes, and then convertible debt, and then preference shares. Then we resort to ordinary share capital as a last resort. The justifications that underpin the pecking order theory are that companies who want to minimize issue costs. Retained earnings do not have those costs attached because they are our own funds already. Then companies want to minimize the time and expense involved in persuading outside investors of the merits of the project. So we are at liberty to just start funding our project right away without taking the hassle of incurring heavy advertisements, trying to persuade people to invest in our company. We can simply just do what we can do using our own money. Then the existence of asymmetrical information and the presumed information transfer that result from management actions, that is to preserve competitive secrets through retained earnings finance, then debt, and lastly, equity issues on new projects. Sometimes it is a competitive advantage to just fund your own business activities with your own money other than to just obtain it from external parties. Why? Because those external parties might want you to disclose more about your new project, which might put its competitive advantage on danger. Okay, because by disclosing that information, you end up selling out your ideas to competition. So it is better and advisable to just fund your own things using secret funds that will keep your company secrets intact. Okay, then lastly, there are some certain issues we need to discuss about the CAPM because the capital asset pricing model. In the previous video, we discussed some bits about it, but I feel we need to speak more on this model as we conclude our lecture. Okay, it has been a very long week, but I feel that you guys are benefiting from this presentation. Okay, now generally we assume that investors overall are well diversified and that therefore it is the level of systematic risk that matter. Okay, so we need to understand what systematic risk is and what unsystematic risk is. Remember, the formula for the CAPM model is as follows, and this formula is given in your exam where we are saying expected return from an investment. Okay, the expected return or the return required by shareholders is equal to the risk-free rate plus beta multiplied by the return from the market minus the risk-free rate. Okay, this is the capital asset pricing model, and we discussed much of these variables in this formula in our previous video on cost of equity. Okay, now I think it is expedient to discuss the concepts of risk. All right, but before that, I think we need to look at the assumptions of the CAPM. Okay, its assumptions. Now, the first assumption on which the CAPM is based is that investors are risk averse. Okay, investors are pessimistic. Okay, they fear to invest in risk portfolios. Okay, they fear to invest in risk portfolios. Okay, or they do not want to take risk, right? And the security returns are normally distributed. All right, which means okay, this simply means that the investors have similar expectations. All right, then when the security returns are normally distributed, simply means that the investors have got similar expectations of risk. Investors have similar expectations of risk. Okay, they have got similar expectations of risk and return. All right, so in other words, all investors estimates all investors estimates of risk and return are the same. All right, their estimates of the risk and return are the same. Okay, their estimates of the risk and return are the same. So this simply means that the estimates of mean and variance lead to different, to the same forecast. Okay, this simply means that the estimates of the mean and variance would lead to the same forecast. Right. So in other words, when the items in a population are normally distributed, it means that using one item or a few items in that population, by the end of the day, you are going to come to the same conclusion concerning that population. All right. You are going to come to the same conclusion regarding that population. So if investors have returns which are normally distributed, it means that these investors have similar expectation of risk and return. All right. Similarly, when we talked of the fact that the investors are risk averse, we are simply saying that these investors base their decision, their investment decision, on the state of risk and return, okay, or the nature of risk and return expected on this particular investment. Hence, these investors, they do not want the risk because their idea is simply based on risk and return. Okay, what benefit are we going to get when we take this particular action? So these investors, they fear to suffer losses. So basically, that's the idea about the capital. Generally, investors are risk averse. They don't want to engage in things that might put them in danger. Now, the utility function of investors is quadratic. Okay, when we are talking of utility, we are simply talking about the investor preferences. Okay, the investor preferences. Now, investor preferences are quadratic. The preference function is quadratic. All right, so this simply means that investors prefer more to less. So because the investors are risk averse, they only engage in such a deal or an investment that would increase whatever utility they can get from engaging in an action. All right, so they prefer more to less. All right. What else? Investors have homogeneous expectations. This simply means that they have identical subjective estimates of the means, variances, and covariances among returns. All right, so as I have already pinpointed, it is consistent with the normal distribution. Then investors can borrow and lend freely at riskless rate of interest. The market is perfect. There are no taxes, there are no transaction costs, securities are completely divisible, the market is competitive. Then the quantity of risk securities in the market is given. The quantity of risk securities in the market is given. These are the assumptions, ladies and gentlemen, and we just have to name a few of them in the exam. All right. We are not required to originate the utility function, the quadratic utility function. We are not required to derive that function or to prove or unprove it. We are not required in this particular exam. Okay, we just have to read around those assumptions as they are very important. Now, let us do one or two examples concerning the kappa, all right, and we call it a day. So let us look for one or two examples linked to the kappa. All right. Okay. The risk-free rate is equal to 5%, market return 14%. What returns should be required from investments whose beta values are 1, 2, or 0.5? Okay, this one, we know that the kappa formula is E R is equal to RF plus beta RM minus RF. Okay, and here we are given the RF as 5% plus the beta for part 1, the beta is 1, so 1 multiplied by RM, that is 14% minus 5%. And here we get 14%. Then for item 2, ER is equal to RF plus beta RM minus RF. Therefore, ER is equal to RF is 5% plus 2, 14 minus 5%. And in this case, we get our 23%. Then we have got ER is equal to RF plus beta RM minus RF. Don't worry, this formula is given in the exam. So that RF is 5% plus beta 0.5, 14% minus 5%. And we get our 9.5%. Okay, so easy, isn't it? Remember, this formula is used to calculate KE, okay, or RE. This is how KE can be written, okay, KE or RE. It's just the same, okay, don't be confused. All right. Now, we have already pinpointed that the assumption of the kappa, the first assumption was that investors are risk averse. Okay, and the risk we are talking about is the business risk. Okay, we are referring to business risk. Now, why is it that some shares in some companies are viewed as inherently more risky than shares in other companies. It is because the nature of their business is more risky. As a result, the potential fluctuations in profits and hence dividends in the future are greater. If things go well, shareholders may well receive much higher dividends, but the risk is that things may go badly, in which case they will receive much lower dividends. The greater the potential fluctuations in returns, the greater we say that the risk is. Okay, so risk matters. But there are two types of risks we need to consider. There are two types of business risk we need to consider. The first one is unsystematic risk, okay, or company specific or diversifiable risk. This is risk due to factors within the particular company, such as poor labor relations or the appointment of a new management director. So this risk is only, peculiar to a particular company. This risk can be reduced by diversification. If we diversify in various portfolios, then we can reduce this risk. All right? Now, there is a risk that we cannot diversify away, and this is the market or systematic risk. This is risk due to the general economic factors such as the level of inflation or changes in the exchange rate. So, a shareholder can remove the unsystematic risk by creating a portfolio of shares on the basis that although each share individually has unsystematic risk, it cancels out with the risk of other shares in the portfolio. We say that a well-diversified portfolio is one where the unsystematic risk has been completely removed or diversified away. Systematic risk exists in all companies and cannot be removed. All companies will be affected by, for example, the level of inflation. However, the level of systematic risk depends on the type of business and will be different for different types of business. Although each individual shareholder may not hold a well-diversified portfolio of shares, we assume that shareholders overall are well diversified and that it is shareholders overall who determine the return given by a share, because it is they who determine the market value of the share. The capital asset pricing model assumes therefore that it is the level of systematic risk that determines the required return from an investment. That risk we can't diversify away is the risk that matters for our CAPM computation. So in the exam, you may be asked, which particular risk matter? It is that risk that cannot be diversified away, which is the systematic risk. And what is systematic risk? Systematic risk is the risk that is caused by the general economic factors such as the level of inflation or changes in the exchange rates. Okay, now there is one last thing we need to know. The examiners have discovered that the formula for for the calculation of KE using the CAPM is actually very, very simple. So they do tricks, they play tricks with you to ensure that they can trick you in the exam by asking questions like determine the beta, determine the risk-free rate, and so forth. It's just an issue of understanding what the scenario or what the question is saying, and then you have to slot in the figures and the variables. It is very rare for the examiners to just give you the figures and simply say calculate the cost of equity using the CAPM. No, they don't usually do that. They will just give you a scenario and you just have to lead yourself using these formulas, but using your own principles. Let us look at this particular question and illustrate how you need to attack the question. Shagasha PLC is giving a return of 20%. The stock exchange as a whole is giving a return of 25%, and the return on government securities is 8%. What is the beta of Shagash PLC? So in this case, we are not told to use any CAPM or whatever, but we know at the back of our minds that the beta is found in the CAPM formula. So we need to use the CAPM formula for us to determine a beta. Remember, in one of the videos, I said there is no way you are going to be required in this particular exam to compute the beta from statistical metrics like covariance and so forth. No, you're not going to be required to do whatever econometric that is linked to the origination of a beta. What you are required to do as an accountant is just to use the common formulas. For example, the CAPM. All right, so you come here and say ER is equal to RF plus beta RM minus RF. Now, the return for the Shagasha PLC is giving a return of 20%, and the return is this amount, the KE. Okay, so 20% is equal to RF. The RF is 8%, which is the return on government securities. So that's 8% plus beta, because you are required to calculate the beta. Then the return on the market, the stock exchange is the market. So the return on the market is 25% minus 8%. So 20% is equal to 8% plus beta 17%. Okay, 20 minus 8, that's 12%, is equal to beta 17%. Therefore, beta is equal to 12% over 17%. This makes the beta is equal to 0.706. That's the beta. All right. Now, is this particular beta risk or not risk? You might be asked such type of questions, all right, in the exam. All right. One thing you need to know about these betas is that they are the measures of risk. So if a beta, if an investment has a beta of 1, if beta is equal to 1, all right, okay, it has 1 times the risk of the market. If an investment or if the security has a beta of 1, this means it has 1 times the risk of the market, or it has the same risk as the market. If an investment has beta greater than 1, beta greater than 1, this means it is more risky than the market. Okay? It is more risky than the market. If the investment has beta less than 1, then it is less risky than the market. So, which means the opposite is true. What about if the security or the investment has a beta of 0? This simply means that the investment has 0 risk or has no risk. So we say that it is risk-free. Okay, how can you prove that? If the beta is 0, let us, in this example, if we put a 0, you can see that the only value we are left with is the risk-free rate. Okay, so that investment is risk-free. Are we together, ladies and gentlemen? Okay, now these betas help us to determine or to calculate the cost of equity, which can be used to evaluate a project. Okay, when we want to evaluate a project, the CAPM can be used. So when we consider an investment in a new project, then since it is shareholders' money that is being invested, we should appraise the investment in the same way as would shareholders if they were investing their money directly. As a result, the required return from the project and hence the discount rate should be calculated from the beta of the project. This simply means that we need to determine the beta specific to the project we want to venture into. Okay, so let us have a look at this problem. Alexia PLC is all equity financed. It wishes to invest in a project with an estimated beta of 1.4, which is significantly different from the business risk characteristics of Alexia's current operations. Okay. The project requires an outlay of $100,000 and is expected to generate returns of $15,000 per annum in perpetuity. The market return is 11% and the risk-free rate is 6%. Estimate the minimum return that Alexia will require from the project and assess whether or not the project is worthwhile. So here we are given a hybrid question which requires us to calculate the cost of equity, that is the return required by the investors. All right, then to determine whether the project is worthwhile. And you know that when the question comes like that, you would be required to calculate the NPV of the project, because the NPV is the best way to determine the worthiness of a particular project. So a required return, the required return is ER is equal to RF plus beta, okay, plus beta Rm minus Rf. Okay, remember ER, I said this one is just the same as KE or RE. Okay, don't be dazzled by that. So in this case, our risk-free rate is 6%. So 6% plus the beta, okay, plus the beta. The beta is 1.4. Okay, that is market return 11% minus 6%. So this should give us 13%. Okay, from this we then have to determine the NPV. So we've got the NPV table. We need to draw up NPV table. We start with the years, the cash flows, discount factor at 13%, because we've determined 13% then PV. So year 0, that's the initial investment 100,000. Okay, so year 0 discount factor is 1, and we get our 100,000 negative. And then this project is going to generate cash flows or generate returns of 15,000 per annum to infinite. So that's from year 1 to infinite. Okay, that's the infinite sign, and that's 15,000, okay, money which we are going to get. So 15,000 to infinity, this simply means that that's 1 over 0.13. We multiply by 0. We multiply 15,000 by 1 over 0.13. Remember our formula for a constant dividend forever. A constant dividend forever is calculated, the market value of a constant dividend forever is going to be the market value of a constant dividend forever is going to be the market value of a share where the company is paying a constant dividend forever is going to be D over KE. Okay, so in this case, the inflows are 15,000 over KE. Our KE is 13%, so 0.13. This is the same here. This is what we are doing. 15,000 over 0.13. Okay, all right. So that's 15,000 multiplied by 1 over 0.13. Please don't be confused. We are still on track. So if we add them up, we get our NPV, that is 15,385. That's the NPV. So as the NPV is positive, then we should say the project is worthwhile. Okay, in this case, I'm sure we have noted one thing. Okay, the presumption according to this question is that the business risk is not linked to financial risk. All right, it could be due to the nature of the processes of this entity, right, but which are not linked to financial risk or which are not linked to gearing. Okay, but gearing might have a consequence. When a company is geared, then we need to adjust for the effect of gearing. Okay, we need to adjust for the effect of gearing. Any gearing in a company makes a share in that company more risky. Published betas are for the shares and therefore measure not just the business risk of the company, but in addition, the effect of any gearing in the company. We call this the share beta, or the equity beta, or the geared beta. There is a formula which is given to you in the examination which allows you to remove the effect of the gearing and calculate the beta. Calculate what the beta would be if there was no gearing. We call this beta the asset beta, or the earnings beta, or the ungeared beta. So the formula is as follows: BA is equal to VE over VE plus VD 1 minus 3 multiplied by beta equity, or multiplied by beta geared. Remember, BA is asset beta, okay, which is ungeared beta. All right, then plus VD over VE plus VD. Remember those VD and VEs, that's VD is market value of debt and VE is market value of equity. And 1 minus T is the tax adjustment. Then BD is the beta of debt. But because beta, debt is considered risk-free, then normally we ignore this part unless otherwise told in the exam. Okay, so debt is risk-free, therefore we normally ignore, and our formula usually ends here. Okay, that is the case. Now, let us look at this example and see what will be happening. Nairobi Bay NB PLC has a gearing ratio debt to equity of 0.4 and the beta of its shares is 1.8. Windowcraft WC PLC has a gearing ratio of 0.2 and the beta of its shares is 1.5. The rate of corporation tax is 30%. Which of the two companies is more risky? Okay, which of the two companies is more risky, and which company has the more risk business activity? How do we determine that? Okay, we need to calculate the beta asset of each company. Okay, we need now for part A, we don't actually need to calculate anything, okay, because by looking at the betas, we can tell that company Nairobi Bay has got a larger beta. Okay, so a larger beta simply means that that company NB, okay, Nairobi Bay, is a more risk share, okay, or the company security can be considered to be more risky, okay, more riskier than considered to be more risky than those ones of WC, because the beta of Nairobi Bay is higher. Okay, now which company has more risky business activity? All right, here we need now to compute. Okay, we need now to compute our beta assets. Okay, we need to compute our beta assets. All right. Okay, I think we can squeeze beta asset for Nairobi Bay NB PLC, the beta asset. Okay, remember beta asset is VE over VE plus VD 1 minus T multiplied by BE, and we are given the beta equity, which is the beta of its shares. Okay, that one. So the VE, remember we are given the debt to equity ratio of 0.4. All right, the debt to equity ratio of 0.4. All right, and we have the formula here. Okay, okay, so in this case we can if we are looking at these formulas, we can actually see that the VE is on top, but you need to identify the VEs and VDs. This is our VD. Okay, so if VD is 0.4, VE is not 0.6, please, in this ratio. All right, because VD is, I mean, the ratio of VD over VE is equal to 0.4. All right, the gearing ratio is 0.4. This simply means that VD is 0.4 and VE is actually 1. Okay, VE is 1. So therefore, if VE is 1, this simply means that VE is equal to 100. Okay, 1 is in 100%. All right, so what happens is we are going to say 100, okay, over 100. Remember our formula, let me just replicate it here, is VE over VE plus VD, 1 minus T, all right, multiplied by BE. This is the formula we are talking about. So 100 over 100 plus 40, all right? Remember, this 100 is the same as 1.00, all right? So like and like, we can't say 100 over 0.4. It doesn't work like that, okay? So it's either VD over VE ratio is 40 as to 100, or simply 40 over 100, or simply 0.4. So in this case, the 40 is to be adjusted for tax, okay? And the tax rate is 30%. 1 minus 0.3, that's 0.7. So this should be multiplied by 0.7. And then multiplied by the beta equity, which was 1.8. And when you punch these figures in your calculator, you must get 1.406. This is the beta for NBPLC. We can also calculate the beta for WC PLC. That's BA is equal to 100 over, that's 0.2 is just 20, so that's 100 plus 20 multiplied by 0.7, okay, or multiplied by the beta which was 1.5. And this gives us 1.316. Okay, so once again, comparing these beta assets, you can as well see that this company is more risky. Okay, now from this, we then have to get a step further in calculating a project-specific discount rate. Okay, so how do we do that? We then have to follow certain steps. We need to first determine the beta for the project, as we did in the cost of equity for the project, in our example for the cost of equity for a particular project. So if necessary, we need to use the beta of a similar company. If the beta is a share beta, then it will need to be ungeared using the gearing of the similar company. So firstly, you need to determine the beta for the project. If necessary, use the beta of a similar company. If the beta is a share beta, then it will need to be ungeared using the gearing of the similar company. Okay. If the project is to be financed entirely from equity, then the required return, and hence the discount rate, will be determined directly from the beta calculated in step A. So we need to remember these steps whenever we are determining a project-specific discount rate. Now, before we do an example that follows, we need to determine, or to just relax and reflect. Why is it important that we need to calculate an appropriate discount rate? The simple trick is that we have already known that the market value of a firm is equal to the incremental cash flows, or the future cash flows, discounted future cash flows, discounted at an appropriate discount rate. Remember, it was WACC some time ago, okay, or it was some form of dividend over KE. So which means that this discount rate matters. Okay, so we want to determine an appropriate project specific discount rate, because that one has an impact on the wealth of an enterprise, on the market value of an enterprise or the project which is being considered. So let us then do this particular example and see if we can be happy with the lecture as a whole. So let's have a look at this one. Leicester PLC is an oil company with a gearing ratio debt to equity of 0.4. Shares in Leicester PLC have a beta of 1.48. So we are given an equity beta. And an equity beta has got two things. Okay, it's got both business and financial risk. All right, business and financial risk. They are considering investing in a new operation to build ships and have found a quoted shipbuilding company, Yunus plc. Yunus plc has a gearing ratio debt to equity of 0.2 and shares in Yunus plc have a beta of 1.8. The market return is 18% and the risk-free rate is 8%. Corporation tax is 25%. Calculate the project-specific cost of equity. So we just have to follow those steps above. So the first thing we need to do is to determine a beta for the project. Remember, we need to first remove the gearing. Okay, we need to first remove the gearing because the company which the comparable company, we want to venture into a new project, into shipbuilding. Remember, our business is an oil company, so we want to venture into a different market. So we need information from similar companies, and the similar company which we now know is Yunus plc. Yunus plc has got a beta of 0.8. This beta is a share beta, is an equity beta, so it is a geared beta. We need to remove the financial risk and then work with the business risk only, okay, of shipbuilding. So we want to de-gear this beta. We want to remove the gearing. Okay, so how do we do that? We do the first step of calculating the beta asset. So BA of Yunus is equal to the market value of Yunus, market value of equity of Yunus equity. Remember, the market value, we can determine it from the ratio. This is the debt portion. Okay, the debt to equity ratio, okay, is 0.2. So which means equity is 100. So the equity is 100. Always know that when you are given the ratio. Okay, so that's 100 plus 20, and then the tax rate was how much? The tax rate was 25%. Don't create your own 30%. If the examiner says 25%, follow that. So 25 minus 100, that's 75%, so that's 0.75. Multiply by the beta equity, and the beta equity for Yunus was 1.8. Okay, so the beta asset is 1.57. Okay, this was the first stage. Then the second stage, we have to re-gear. Remember here, the stage, this one was to de-gear. Okay, so we now want to re-gear, but we are re-gearing the beta asset to our own beta, okay, to the project's beta. Okay, so we are re-gearing to Lister's beta, Lister beta. Okay, so that's the next stage there. So we know that the beta asset now, remember, we are still using the beta asset formula, but we now want to determine the beta equity. Remember, okay, so the beta asset, we calculated it above, that's 1.57 is equal to 100 over 100 plus, now remember the ratio of Lister is 0.4 debt, that's 40, so debt is 40. Okay, the percentage, we just use the same tax rate adjustment, so that's multiplied by 0.75. Okay, multiply by beta equity. Remember, we want to make beta equity subject of the formula. So BE, if you make everything the subject of the formula, BE is now 2.041. Now we use this BE to calculate the required cost of equity. So KE is equal to RF plus beta equity RM minus RF. So our risk-free rate from the question, the risk-free rate is 8% and the market return is 18%. So 8% plus BE, that one, 2.041. RM is 18% minus 8%. Okay, and this gives us 28.41%. So this is how we need to do it. Okay, this is how we need to compute these computations or to carry out these computations. No need to panic. All right, so the last bit of this week 6 lecture is something to do with business valuations. Okay, something to do with business valuations, and we have got about 3 methods of valuing businesses. We've got the assets approach, we've got the income approach, where we'll be using the price earnings ratio, and then the cash flow based approaches. Okay, and these include the dividend valuation model, as well as the cash flow, the discounted cash flow techniques. Okay, and I think of interest is the discounted cash flow technique. All right, the asset based, those ones are straightforward. You can use the notes, and when you face any challenge, please always get in touch with me. All right, and I think we just need to see how the computations are done in a discounted cash flow technique, but by the end of the day, you will discover again that everything is just as simple as they are. Okay, let's look at this particular example for a cash flow based approach. Okay, we have a firm called Basop. Basop wishes to make a bid for Palesa. Palesa makes after-tax profits of $40,000 a year. Basop believes that if further money is spent on additional investments, the after-tax and interest cash flows, ignoring the purchase consideration, could be as follows. Year 0 up to 5 cash flow net of tax and interest. The cost of equity of Basop is 15%, and the company expects all its investments to pay back in discounted terms within 5 years. What is the maximum price that the company should be willing to pay for the shares of Palesa? What is the maximum price that the company should be willing to pay for the shares of Palesa if it decides to value the business on the basis of its cash flows in perpetuity, and annual cash flows from year 6 onwards are expected to be $120,000. So let us attack this question straight away. Part A, what is the maximum price that the company should be willing to pay for the shares of Palesa? So this is actually a simple NPV question. Okay, that's a simple NPV question. All right. The maximum price is one which would make the return from the total investment exactly 15% over 5 years, so that the NPV at 15% would be 0. It is suitable to use the cost of equity because the cash flows are after interest. Okay, so we are given these cash flows after interest. Okay, so the most appropriate discount rate is actually the cost of equity. Okay, now let us do it. Yeah. Okay, the cash flows. And then discount factor at 15%. Then the present values. So we're looking at year 0, year 1, year 2, year 3, year 4, and year 5. And then the cash flows negative 100,000, negative 80,000, 60,000, 100,000, 150,000, 150,000. The discount factor year 0 is always 1, and then from our tables, this is 0.870, 0.756, 0.658, okay, 0.572, 0.497. If you multiply across, this gives us negative 100,000, negative 69,600, and 45,000, 360, 65,800, 85,800, 74,550. We add them up and we get the maximum price payable, and this is 101,910. That's the maximum price. Maximum price they can pay. Okay. Now, part B wants us to determine the maximum price that the company should be willing to pay for the shares of Palesa if it decides to value the business on the basis of its cash flows in perpetuity and annual cash flows from year 6 onwards. I mean, if its cash flows are expected to be 120 after year 6. After year 6. So if the shares are to be valued on the basis of cash flows in perpetuity, we need to add the PV of annual cash flows from year 6. So we just have to continue from where we left there. So what we need is to add the PV of annual cash flows from year 6. So the value of the cash flows from year 6 onwards in perpetuity, okay, at a year 5, okay, at a year present value is as follows, because we are told that from year 6 we are going to get 120,000, okay. And remember here, a perpetuity is the same as PO is equal to D over KE, okay. That's a perpetuity. So we come here and say part B, the value, okay, market value is equal to 120,000 over KE, and our KE is 0.15, and this gives us almost 800,000, okay. But we need to discount this by the base year, okay, by the base year. Remember, this is from year 6. This is from year 6. So we need to discount by base year, discount by discount factor of the base year. The base year is year 5, okay. So the year 5 discount factor has to apply. So multiply by the year 5 discount factor, which was 0.497. Discount factor year 5, remember, was 0.497. Okay, and we must get 300, okay, 397 $600. So our valuation has increased. The market value now is increased, okay, from has increased from 101, which we discovered here, 101. This was the original market value by year 5. So that's 101,910 to 101,910 to, it was increased to 0115, okay, 994. So you can see that the difference between this valuation in B and that in one, in A, is actually huge, okay. So this might illustrate that the business valuations depend crucially on the assumptions that are used to reach the valuations. All right. So the assumptions in any exam situation, you need just to tell the examiner that the assumptions that the business is going to be profitable, is going to give us this cash flow, needs to be investigated, needs evidence. We need evidence to substantiate those claims that we are going to make such cash flows in perpetuity. Okay, we need to substantiate those claims. But all things being equal, this is how we do the computations concerning business valuations based on cash flows. All right, I'm sure we are done. Okay, the other valuations, the dividend valuation models, we talked about that one, because remember, PO is the market value, so it will be valuing. So if you use the dividend valuation model and you get the price per share, that is the market value per share. Okay, you then have to multiply by the number of shares to get the total value of the firm. Okay, total value of the firm. You know, those ones, that's very simple. Okay, when we are talking of asset valuations, we know that there are about 3 valuation methods related to assets. We've got the book value approach, okay, where we simply use our financial records to determine the historical values of the assets. Okay, but these ones are not useful because in most cases the values would be outdated and so forth. They won't be very relevant. And then the net realizable values, these ones are usually the best methods to be used. Okay, the net realizable value, we'll look at this particular, the replacement cost, those ones, the replacement value. Once again, they are not of great practical benefit. The approach tries to determine what it would cost to set up the business if it were being started now. Okay, the value of a successful business using replacement value is likely to be lower than its true value unless an estimate is made for the value of goodwill and other intangible assets such as brands. Furthermore, estimating the replacement cost of a variety of assets of different ages can be difficult. So the NPV, the net realizable value, is actually the most useful. This one says that this amount would represent what should be left for shareholders if the assets were sold off and the liabilities settled. So this one seems to be better because it also looks at some market values to some extent. Okay, there is need for some market values to be incorporated in the net realizable value. Okay, let us look at this small information and see if we can understand. So the business non-current assets contain land and buildings that are valued. So remember, this is the original, the book values. These are the book values of the business. Okay, but we are told that these non-current assets, okay, contain land and buildings that are valued at 700,000 above their book value. So we can see that there was an over the non-current assets at 1,000. Okay, they were containing, okay, the non-current assets were containing the land and the buildings that are valued $700 above their book value, which means the book was showing a lower amount. Okay, the book was showing a lower amount by 700,000 because in essence or on the ground, the non-current assets are actually valued or they are worth by 700,000 more. Okay, they worth more than by 700,000. So which means in the records they were undervalued. So what do we need to do? We have to add the missing value of 700,000. Okay. Now, for us to dispose of these assets, we need to incur a cost of 200,000. So which means we then have to say 1,000 plus 700 minus 200. The actual value of the asset is now 1,500. Okay, then we go to the current asset. All right, the book value was 500, but we need to adjust this figure by what is obtaining on the market. The inventory would sell for 400,000. Okay, sell for 400,000, which means we need to deduct 100 so that the actual inventory value should be adjusted to 400 because that's what we are going to fetch if we are to dispose of the inventory. Then only 250,000 would be realized from receivables. So our receivables value should actually be 250, which means if they were, according to the record, 300, we then have to less them by 50. Okay, the cash value is the amount. The cash can't change. Okay, the cash will just be the same. So you can see that our total assets have been adjusted from a total of 2,200 to 2,550, depending on what actually is obtaining. Okay, so that's how you can value your business. All right, remember, the total assets should agree with the total equity and liabilities for the balance sheet, for the statement of financial position to balance. So once you determine this figure, obviously the total figure for the total equities and liabilities should actually be the same. Okay, and you need also to appreciate that the reserves are the most to be affected, as they as they absorb or unabsorb what would be happening in terms of the value changes in values. Okay, there is going to be some impact on the retained earnings and so forth. So this is why the movement is being explained in the changes in the reserves there. Okay, so I think, ladies and gentlemen, we have benefited a lot from this presentation. And should you guys feel like, hey, we need to be taught further, this is your opportunity. Please become a student, and those are my contacts, and that's the number and the email. 24/7, I will always be online so that you guys get the support you need. Until next time, ladies and gentlemen, may the good Lord continue to bless you and make you prosperous forever and ever. Amen.